Senior Research Economist at Veros. And joining us today is Eric Fox. He's Chief Economist at Veros. Eric and I are delighted to welcome you, Sep, to our webcast today. Sep Niakan is Managing Broker of Black Book Properties and a real estate sales top producer in the Miami area for the past 15 years. Please tell us a little bit about yourself, Sep.
Sure. I own a real estate brokerage here located in the greater downtown Miami area. We service the coastal areas of Miami and the Miami beaches. And I actually also founded condoblackbook.com. So we focus on luxury coastal neighborhoods and primarily sell condos, but also single family homes. So we have a lot of data, a lot of information about what's happening down here, and hopefully we can offer some help today.
That will be wonderful. We are glad to have you here. So, I've been reading a lot of articles on the Miami housing market, and these reports are kind of quite varied. Some are saying continued growth, Miami is a booming market, and then there are some predictions that there's going to be a significant downturn. So, could you offer some insights on the current state of the market and what factors are contributing to this current state?
Sure. Yeah. Well, Miami's definitely a dynamic market, and there's always headwinds and tailwinds. Of course, during COVID and the post-COVID environment, we had a massive in migration of people, primarily from other large cities in the U.S. And they found solace and happiness here, both on a social level and financial and lifestyle level. People have come and will always come here for the great weather, the fact that Florida has no income tax, and also the business-friendly and also the landlord-friendly environment for investors as well. And so we've been attracting ultra high net worth individuals and generally a more wealthy demographic. And that trend continues to happen. And you can see that in the new construction projects that they're building, the larger, more luxurious properties that they're offering and how quickly that they're selling. Just a couple of points to demonstrate those trends. Citadel, which is one of the largest hedge funds in the U.S., is relocating their entire business to South Florida, to Brickell. Florida's net income migration is number one in the U.S. of any city at 36 billion in net income gained last year. I think it was last year or the year before. As well as we're the number one destination for ultra high net worth individuals, number one worldwide for people with 100 million or more in investable assets declaring residency here. So those are just some examples. There's certainly, so long term, there's a lot to be gained from participating in the South Florida market in general, not just Miami, but South Florida, Tri-County area, Palm Beach County, Broward County, and Miami-Dade County. Miami typically leads the growth and is always the most active, but it also flows in those areas very well, especially the Palm Beach area for high net worth individuals. There's certainly some tailwinds as well. Recently, the past few years, insurance costs have gone up, which has impacted both single-family homes and condos. When it comes to condos association fees that you pay each month, one of the biggest factors is the insurance cost. And then the second biggest factor is the cost of employees that run the business, so run the condo. So because of inflation, of course, employee costs have gone up as well. And frankly, South Florida leads the country in wage inflation. We have a very low unemployment rate of under 4%. And so because of that, we have higher wage inflation. So association fees have gone up. That's a little headwind. And that's causing some people to pause. Interest rates have also been sort of steady in the 6 to 7% range. mortgage interest rates, 30-year fixed. So that also has some people pausing. However, it's the news, a lot of the news that you might see on the market, sometimes they focus on extremes. Like, for example, a condo that's older, and I think we were talking earlier, you wanted to talk about the new condo laws. Older building gets $100,000 or $200,000 special assessment. That's an extreme and an exception, as opposed to the rule. The rule is condos need to take care of business. The new condo laws require more inspections more often, require reserves, which is savings accounts for condos, so that when they have major repairs and major renovations that they have to do, the money's already sitting there. And so right now, a lot of buildings are playing catch up with those new requirements, which is causing some turbulence in how buyers are perceiving things, and with the expense of owning a condo right now. So those are definitely some tailwinds as well.
Okay. So basically, so then what is your prediction in terms of how much are prices going to grow? I mean, home prices, you think like continued double-digit growth, low single-digit growth? Where do you think it's headed?
So there's the latest prediction, I think, from the Miami Realtor Association and some other sources, is that single-family homes will have single-digit growth, maybe mid to high single-digit growth. Condos, there's the actual prediction that I read was that it's going to have very low single-digit growth. However, it's a very nuanced market. So it depends on which part of the market you're looking at, where that's going to go. I believe there is some chance that there's going to be some cracks in the market, and there will be some price drops in certain types of properties and certain price points. And then there are other properties and price points that will not see any price drops and will see price increases. So it's not a single, it's a mixed bag.
Okay. That's what I thought, that probably entry level, the entry level segment is not doing so well, but the luxury segment continues to grow rapidly. Is that correct?
It's even in there, it's a little bit of mixed bag and sometimes counterintuitive. So the entry level market is more impacted by things like the higher the interest rates, right? And higher monthly expenses. However, there's a much smaller bucket of entry point properties to buy. So the inventory is lower. So if you look at the days on market and the total months of inventory, you'll find that the lower price properties actually don't sit on the market as long, and there's less months of inventory available, not just absolute inventory, but the months of inventory calculation, which is combining the actual number of properties available with the speed at which they're selling. Right? When you start creeping up, it's partially price point and partially building age that's somewhat impacting what happens next in each of those categories. So the newer properties, the properties that are, let's say, less than 10 years old, generally are faring probably a little bit better than the properties that are built in the early 2000s, like 2010 to and before. And then those are probably faring a little bit better than the buildings that are built 25 years old or older. Why? Because the new condo laws changed from 40-year milestone inspections, which is a safety and overall health of the building inspection required by the state, to 25 years. Now the standard is 30, but if you're within 3 miles of the coastline, you're at 25 for Miami-Dade County. So a lot of that part of that has to do with the buyer perception and the buyer sentiment, not always strictly about what's actually happening in those buildings. If a building is 25 or 30 years old, it doesn't mean that it's a problem building and that it will become a problem building. It could be actually in excellent shape, but it's buyer perception and, fear. with the buildings that are built to 2000 to 2010, for example, those buildings are having to go through some updates, some aesthetic updates, some repairs, roofs, AC, cooling towers, and so on. And so there's a temporary increased expense that comes with special assessments, things like that, in certain cases that cause people to pause. They have to factor those into their purchase decisions. And then pre-construction properties, like ones that are not yet built, and I guess a lot of people call those on plan around the world. Here we just call them pre-construction properties. Those properties, again, depending on where, for the most part, they're doing very well. The ones that are premium luxury and ultra luxury are doing exceptionally well, or let's say relatively better than the rest of the market, because that's the demographic of people that are moving to South Florida, and the existing inventory in South Florida doesn't serve their needs as much in many cases. They're not luxurious enough, or they're not large enough, or they're not new enough. And so they almost have no choice but to buy on plan or pre-construction to get what they want. For example, if you want to go to Brickell and buy a extraordinary luxury waterfront property that's new, doesn't exist. So you have no choice but to buy an on plan at the St. Regis or the Mandarin Oriental or buildings like that. And so if you go to each sub neighborhood, you'll find similar situations. And that's why I think the premium luxury, which let's say is like 5 million and up, and the ultra luxury, which depending on who you ask, it's 10 to 20 million and up. Those properties are doing very well.
Well, it's very interesting listening to you speak about the condo market here. I think we see so much in the news about the older condo market, which don't have the appropriate reserves, which haven't done the maintenance that they should have done, that are in a world of hurt. And from what I'm hearing, sounds like there's a kind of a luxury, a new condo market. There's an older condo market where everything's just fine because they've done a good job over the years. And then there is still that older condo market where there's problems. And I guess one question I wanted to ask you is, how do you see the end game playing out for some of these older condos where we read the stories about the $100,000 assessment, the people have been in the condo for 20 years, they can't afford it. How do you see that playing out?
So frankly, I see some pain for a number of people over the next couple of years. And then a lot of it will wash out. A lot of it will wash out, and you'll be able to actually, it's overall better for the consumer because of the new condo laws. There's the standards, the study of the building savings accounts called reserves, that has to happen every 10 years. Buildings have to be properly funded for reserves for all safety items, and for structural items. Even the buildings that are built in 2000, 2008, those buildings are catching up. They're reassessing their reserves. They're doing the capital expenditures they need to keep the building in tip-top shape. And all of this pain that everyone's going through, either minor pain or major pain, depending on the situation, ultimately will yield an end result in a couple of years of the buildings being where they need to be, all of them. Of course, there's going to be some buyouts. There's going to be some buildings where it's an excellent location, an amazing lot, and the developer is going to come make offers, and it's happening as we speak today in certain buildings, and it will continue to happen. And so there will be opportunities where the old market will be replaced by something new and extraordinary. So that also will definitely happen. Just so you guys, on a personal note, my parents live in one of the buildings that actually had an extreme case. So I see it intimately from on the inside viewpoint of that. And then I own an investment property that is on a also getting a special assessment, but not in an extreme, but more like on a typical special assessment, so that they can catch up. And we're seeing, I own multiple condos, and their association fees for the most part have risen. A couple have not. So I speak not only as a broker, but as an owner who's seen the whole gamut.
Very interesting.
So, Sep,
So
one
for
of the
example,
things, sorry, carry on.
no, I mean, for example, the building my parents live in, they're getting over $100,000 special assessment. And there's some people that are panicking. There's some people that are selling. There's some people that are going to be fine. But we always have to remember, we have to be sensitive to the people that cannot afford it and might need to make life changes. But we also have to be cognizant of the fact that if someone decides to sell, there's been tremendous growth, value growth over the past few years. Hopefully they'll be okay, because they did, everyone did pretty well over the past few years. And ultimately, the people that move in are part of a renewal process also. That's part of this change that we're going to go through over the next couple of years. And so, there's always that ebb and flow, and that exchange, and the changing of the guards, and people sometimes being somewhat forced to make a lifestyle change. But in the end, it's hard, but is that really the worst thing for them? Maybe it's not. Maybe where they go to next is better. Maybe that's still philosophical, but.
So you're talking a little bit a while back about Florida being one of the top inbound destinations for migration. A lot of people are moving to Florida, and especially Miami. And you said that a lot of them are high net worth individuals. So where are these folks coming from? Is it just domestic inbound migration? Are people coming in from around the world? And who are these people who are coming to? Are they retirees? Are they looking for work? Or are they just like, the snowbirds escaping the cold climates? Who is moving to Florida?
Well, it sounds trite, but everyone's moving to Florida. But if you want to break it down, the number one is New York State, which is mostly, New York City and the metropolitan area there. Number two is California. Number three is Texas. I think it's Texas, and New Jersey's up there as well. I think maybe that's number four. So those are some examples. Basically, major cities, right? If you keep going down the list, you're going to hit most of the major cities in the United States. So that's who's the primary driver of in-migration. However, if you look on a international level, South Florida, I don't know if it's Miami or South Florida, has the number one international immigration in the U.S., the number one for investment in the U.S. in dollars, the number one foreign-born population in the U.S. as well. So, I mean, and I can send you the sources for these if that helps you guys. So it's really, this cycle has been driven by domestic migration from all the other big cities to South Florida. However, historically and still today, a lot of growth in the real estate market and in general has come from South America primarily and Europe secondarily. And I don't have the stats, but anecdotally, the investment and movement from Asia has increased as well.
Very interesting. One thing you mentioned a little bit earlier, Sep, in our conversation today was the higher interest rates. And so I think when we've looked at the future of house prices around various markets in the United States, we're definitely seeing a slowdown in our forecasts. And that's, of course, one of the key variables. How much of an impact is interest rates having on demand in the Miami area, maybe with respect to, buyers that are on the sidelines now that maybe wouldn't have been on the sidelines if rates had stayed low? And how does Miami compare to other markets in Florida, like Tampa's and Orlando's, that we hear a lot about?
In terms of interest rates, the way it all played out has been very interesting, and it somehow is counterintuitive, because interest rates have gone up, which has certainly dampened demand on the buy side for those who need financing to get a property. On the other hand, people are not wanting to let go of their properties that they do have because of the very low interest rates they've locked in. And so you have a situation where there's less buyer demand, but there's also less inventory that there would otherwise be. And so that, I think, has changed the dynamic. And I think you see that across the US. I mean, certainly you have South Florida has bucked the trend of a lot of other primary and secondary cities where they've seen some significant price drops, whereas South Florida has not. Not to say that we're going to be immune to it, but it certainly hasn't happened in the way it's happened in other cities yet. The other factor is that historically, South Florida, especially in the luxury realm, let's say million and up. Now luxury is really 2 million and up here, but let's just say in the million and up, which is premium and luxury properties. We, I think, have the highest cash purchases of the rest of the country. So interest rates do definitely impact us here, but on a smaller scale, especially as you go up the ranks of property price.
Okay, well, that certainly makes a lot of sense. One last question that I have for you is, are you seeing rising insurance rates? And I'm assuming for South Florida, it's predominantly due to hurricanes, but we're seeing it play out in large parts around the country, you know, Southern California with fires, Texas with tornadoes and hurricanes, a lot of insurance companies, I think, realizing that perhaps demand or pricing wasn't quite where it needed to be, and so now they're making up for lost time, I guess. So has Florida been relatively stable, or in this latest round of insurance increases that we're starting to see in other places, have you noticed a pickup in the Miami market?
Well, lucky or unlucky for us, we're typically the leaders in a lot of things, including insurance rate increases, right, in Florida. So we have had significant insurance rate increases past few years, and that's actually been, again, the biggest factor of price increases on the ownership costs, right, which is either association fees or, for single-family homes, just the insurance cost itself directly. I have not heard any news about this upcoming year, having significant insurance rate increases. I wouldn't doubt that it could happen, but it hasn't been neither in the news, neither in the whispers behind the scenes. I have not heard anything as of yet. I would say that maybe in some other parts of the country, they are catching up for unforeseen events that they need to, whereas here, everything that happens is fairly foreseen. We know that every so often we're going to get a hurricane, and that's baked into to the insurance company's plans. The good news is that I think it was last year or the year before, I think double digits or high single digits of new insurance companies and re-entered the Florida market, which is a great reversal, and the expectation is that will balance out and even out the insurance rate increases to make them more palatable and also make insurance just more accessible to more people.
That is really interesting. I mean, I had not heard about this part about insurance companies re-entering the market, because in California, where I am, a lot of them are actually leaving the state because of all the wildfires that are happening.
Yeah, it's too bad.
So is there any other part about the Miami housing market you'd like to share with us? Some other insights you have?
Well, there's a lot going on. I could talk for hours. So it all depends on what you think your viewers might be interested in. We can kind of reverse this and go start over. But what your viewers do you think might be interested in? You tell me if there's something. What are your viewers typically investors? Are they second homers? Are they, what do you think they would want to know in general?
Yeah, I think we have viewers across the spectrum. There are investors. There are a lot of people who are looking to buy a house. They're first-time home buyers, and everywhere I think you would have read about it. Affordability concerns. Where can we buy a house? And it's so difficult right now with the elevated mortgage rate, and house prices themselves are high, especially in a place like Miami. So what do you have some insights for first-time home buyers in the Miami area?
Okay, well, yeah. So, I mean, the good news is that lending is still very healthy. You can get FHA loans, you can get very low down payment, Fannie Mae loans as well for single family homes, and also with condos, 3% down, 5% down. If you're a physician or dentist, nurse, sometimes you can get as low as 0% down with no PMI. So certainly there's some county programs as well that offer down payment assistance in certain cases, mostly applicable to single family homes, and depending on your income level. So I mean, certainly the market is healthy for lending. It's just a matter of if the numbers can work for you with the current interest rates. It's likely that interest rates are going to stay in this range for a little while. The 30-year mortgage rates, not directly related to the Fed interest rates that they announced, the short-term interest rates. So it's affordability is a challenge. It's something that I know the local realtor association is working on. There are micro units being built in some of these opportunity zones that are very close to downtown. There's a lot of more rental buildings getting built, which obviously is maybe not the dream of home ownership, but it's a start to being able to participate in this market and be here and enjoy the lifestyle and the weather and the no income tax and the social and political climate, if that's what attracts you here. Affordability is a real challenge with not real easy answers, but certainly the positive is that the lending market is alive and healthy and lenders want to lend.
Thank you so much for your insights today, Sep. It was great learning about the Miami market.
My pleasure.
Thank you for joining us.
Yeah, thank you again, Sep. We really enjoyed having you on RiskWire today.
Thanks, Eric, and thanks, Rena.
Thank you.